When assessing a client's risk, one of the most important questions is how much exposure does their industry create? Every business operates in a different environment, and some are far more attractive to money launderers than others. Sometimes industry risk is grouped together with entity risk, but it deserves its own look because some sectors are naturally more vulnerable to money laundering than others. In this lesson, we'll look at three key aspects: the nature of the business activity, the types of clients the company serves, and the source of funds and wealth. By the end, you'll understand why some industries attract criminal misuse, while others tend to stay lower risk. Nature of business activity. The first question to ask is simple. What kind of business is this company actually in? And does it make sense from a financial crime perspective? Some industries are naturally lower risk, like regulated financial institutions, local manufacturers, or utility providers. Their operations are straightforward, their money flows are transparent, and they're already under heavy supervision. Other industries, however, are magnets for laundering. Casinos, money service businesses, crypto exchanges, real estate, and precious metals all involve large or fast-moving sums that can hide illicit funds. Even small cash-based companies, restaurants, nightclubs, car washes, can be used to mix illegal cash with legitimate daily sales. Imagine a small restaurant chain that reports strong sales every day. On the surface, it's successful, but behind the scenes, part of its deposits come from unreported gambling cash. By inflating sales, the owner quietly places dirty money into the banking system. It looks harmless, but it's a textbook example of how criminals exploit cash-intensive industries. The key point: the nature of the business determines how vulnerable it is to abuse. The more cash, high-value goods, or unregulated activity involved, the higher the risk. Types of clients served. Next, consider who the company serves. A business's customer base can quickly change its risk profile. A local IT firm working only with small local businesses? Low risk. But a fintech company onboarding clients from multiple high-risk jurisdictions? That's a very different story. The broader, wealthier, or more international the clientele, the greater the exposure. Large corporations, high-net-worth individuals, or politically connected clients add complexity, and complexity creates opportunities for misuse. Ask, does the customer base make sense? A local payment provider with hundreds of foreign clients might signal something unusual. The wider and less transparent the client base, the higher the risk, and the stronger your due diligence should be. Source of funds and source of wealth. Finally, let's look at where the money comes from, both for the company and for its owners. Source of funds tells you how a specific transaction or investment is being financed. For a business, that could mean income from sales, shareholder loans, or capital injections. Source of wealth goes deeper. It asks, how did the owners make their money in the first place? Was it from years of legitimate work or from something opaque or shady? When reviewing a company, separate the initial and ongoing sources of funds. The initial source is the money used to start the business, the seed capital. If that came from unclear or high-risk origins, it's already a red flag. The ongoing source is how the company stays afloat. Its sales, contracts, and customers. If that income doesn't match its business model, it deserves scrutiny. Here's a simple rule of thumb. If the starting capital, current cash flow, or owner's wealth story doesn't make sense, the risk goes up. Always ask, where did the money come from, how does it keep flowing, and does the story hold together? If the answer isn't clear, something might be off. 3 things to remember. Some industries are naturally higher risk. Cash-based, high-value, or lightly regulated sectors, like casinos, real estate, and crypto, attract more laundering activity. These industries demand stronger due diligence and closer monitoring to prevent misuse. Who the clients are matters. A company serving diverse or high-risk international clients carries far greater exposure than one with a simple local customer base. Always check whether the client mix aligns with the business model and its declared risk appetite. And always follow the money. Check where it came from, how it moves, and whether the owner's wealth story adds up. Inconsistencies here are often the first sign of financial crime. A clear and logical source of funds trail is one of the strongest indicators of a legitimate business. Understanding industry risk helps you see where financial crime is most likely to hide. It's not about labeling entire sectors as bad. It's about knowing which ones need your extra attention. By the way, I can send you a list of common acceptable documents for source of funds and source of wealth checks. Just leave a comment under the video if you'd like me to share it.
If you found this lesson useful, you'll find the full Anti-Money Laundering Basics course linked below. It includes all stages, red flags, and practical exercises to help you build real compliance skills.